Hi, you're watching Investor Insights, and today I'm going to be talking about income investing. Basically, income investing is exactly what it sounds like. As opposed to going for growth and capital gains, the investor seeks an income. And he can do that normally in one of two ways. The first being directly investing in bonds, or a bond fund of some kind, or buying stocks that pay a dividend, usually a high yield dividend. Now, if you've been watching these videos, you know my thoughts on bonds. The market is so distorted by the central banks that the bond market is severely overpriced. The yields are so low that you're basically losing out money on inflation if you're looking at bonds to generate an income. You're looking at a 10-year in America at 2.6, 2.7%. You're looking at Australian rates of, I think it's 3.25%. Man, inflation's running at easily 5, maybe 7 or 8%. You owning these assets, which are only yielding 2, 3, 3.5% at best, it's just like taking your money and flushing it down the toilet. So, if you're looking to bonds as a means of income, my advice is stay away. And another piece of advice that I'd like to give you about the bond market is that the bubble has been slightly deflated, and in due time it's going to explode. And if you happen to be owning these bonds, you're going to get crushed. It's not worth chasing 2, maybe 3% yield and then cop a 50% capital loss on your original investment. To me, that's investing suicide. The second aspect of income investing is purchasing or investing stocks with a high dividend yield. Now, I've made videos about companies that pay high dividend yields. And the norm is that once a company is mature enough, large enough, and has grown to such an extent that it can't focus and it cannot see much growth ahead, and thus it just cannot find a good place to invest its free money. So their best option is to pay their shareholders out with their free cash. So if you think about what I just told you, investing in a company that pays a high yield dividend means you're buying into a mature business. The company can't think of ways to invest its money to grow the business, so it's tired, it might as well just pay out its shareholders. To the value investor, it's a good thing. To a person who's a long-term growth investor, a person who wants to see their portfolio double or triple in size, given enough time, these companies aren't going to do it. So very often, portfolio should be a balance of growth versus values companies. And income investing using dividend paying stocks is not a bad way to go. The only drawback to this method of investing, now I'm discounting bond investments, is that you're not going to make a lot of money out of your portfolio. Right now, yields are dropping because there's a stock market bubble happening. So as prices are up, yields come down, and basically the defensives are leading the stock rally. Look at Australia, for example. The growth stocks like BHP, man, they're 36% down over for the past 2 years, whereas stocks like Telstra are up basically almost 100% in the past 3 years. Telstra is one of the worst companies that you can invest in. The stock has absolutely no growth whatsoever. Yes, you see commercials about it's having the largest 4G network. Yes, I've just bought a wireless Telstra modem. Doesn't matter. Its avenues for growth are dwindling. There's so much saturation in the market. There's so many competitors out there that Telstra just can't compete with them. And Telstra borrows money to pay its dividend. So when inflation goes up and interest rates go up, it will have to find alternative avenues by which it can get money to pay its dividend. Because its dividend is the only thing that's keeping the stock alive. I wouldn't own it, not at these prices. Even if it fell back to $3, I would really rethink why it got back down there, and then I still wouldn't touch it with a 10-foot pole. So if your mentality is such that you're not too concerned about growth, you're concerned about a passive means of earning an income, then look into income investing and more towards the dividend paying stock aspect of income investing. A little note I'd like to add: just because a company pays a dividend doesn't make it a better stock than others. In fact, if you think about it, the dividend yield is telling you that the company has run out of ideas or places where it wants to put its profits to grow the company. So if you're deciding to go income investing, I'd stick to dividend paying stocks. And even those, I'd be pretty wary once they've reached a target price. It doesn't matter if you've stripped the dividend, but if that particular company has reached a target price, you should take it.